Hello and a warm welcome. You've joined us here on ET Now. I'm Ashesha Advaryu, and Reliance Industries numbers have just come in. On the face of it, clearly it looks like a good set. On the revenue front, we have seen a growth of about 5% on a sequential basis. 3,09,468 is where the revenue figure has come in for the quarter gone by versus expectations of about 2,98,000. So clearly it's a beat when we compare it to our own poll. Now, as far as margins are concerned, they've come in at 15.4% in the quarter gone by versus 15% that the company had reported in the previous quarter. So on a sequential basis, margins too have expanded by a solid 40 basis points. So it's a good number even when we compare the margin figure. Now, profit figure has come in at about 20,950 crores. That too is a big beat versus expectations. We were working with about 19,100 odd crores, and this again is a 23% jump on a sequential basis. So across all parameters, whether it is revenue, whether it is EBITDA, it's a beat versus expectations. Only on the margin front, it's largely in line with what we were working with. But again, on a sequential basis, Reliance numbers clearly have been better than what we were working with. 5% growth on the top line front, 8% EBITDA growth is what the company has reported to come in at 47,520 crore, and the profit after tax figure has risen by 23% on a sequential basis. Meanwhile, let's also take a look at the segment-wise performance then, and that too has been solid this time around. Let's start with the oil to chemicals business then. And in any case, we were expecting strong set of numbers from here, but O2C EBITDA has risen by a solid 17% on a sequential basis. We were working with expectations of anywhere between 15 to 18% QOQ. So O2C EBITDA has been very strong this time around. Now remember, the marketing margins, the Singapore refining margins have risen this time around because of West Asia conflict, and that is precisely the reason oil to chemicals EBITDA has seen a solid jump up of about 17% on a sequential basis. Other than that, the oil and gas EBITDA has seen an increase of about 19% QOQ. Now remember, we were expecting a decline, so oil and gas segment performance has also been much better than what we were working with. As far as retail segment is concerned, over here we are seeing some bit of weakness where retail EBITDA has declined by 9% on a sequential basis. Retail revenue too has seen a decline of about 8% on a sequential basis versus expectations of about 2 to 3% decline. So retail is one segment where we are seeing some bit of weakness, at least as compared to our own expectations. And digital services revenue, meanwhile, has seen an increase of about 2% sequentially. So overall, when we look at the results, revenue has been much ahead of what the street was working with. Margins have come in at 15.4% this time around, an expansion of about 40 basis points on a sequential basis. And profitability too has seen a jump up this time around on a quarter-on-quarter basis. As far as segment-wise performance is concerned, O2C segment in line with what we were working with. Oil and gas has come in as an outperformer this time around. Retail has slowed down worse than what we were working with, and digital services revenue growth has come in at about 2% on a sequential basis.